Penny stocks are known to have that high potential for growth. In other words, the kind of growth you will obtain through investing in a typical penny stocks. You may not obtain that kind of growth if you invest in a mega cap or large cap stocks. So how do you really spot winners? How do you identify penny stocks that are likely to give you the kind of growth you really want to obtain in the markets? That is the essence of this particular video. So investing in penny stocks can be rewarding, if you approach it with with a high degree of caution, and you support it with thorough research and analysis. So here is how to identify promising penny stocks with high growth potentials. Number one is research the company. You research the company thoroughly. You consider the company's financial performance. You analyze its financial statements critically. You focus on revenue, you focus on profits, on profit margins, and also you consider cash flow. And so a consistent track record of growth is a positive indicator. The company has been growing consistently. That's an attractive factor actually. And you also look at industry position. What's the position of that particular stock in its sector or in its industry? So is it really operating in a growing industry? Is it an industry leader? Does it really have sufficient market share within that industry? You need to consider all this. And you also look into its management team. Do they have good track record? Are they shareholder friendly? Are they credible? Do they really have a clear vision and objective for the company? So you have to take all these questions into consideration. Number two is analyze the business model. You need to analyze the company's business model. In this case, you talk about you consider sustainability. Ensure that the company is is viable, and it can it has a business model that has a tendency to scale. And you also look at the company's unique selling proposition. What is its unique selling proposition? Identify whether the company has a unique product or service that people are really interested in, that tend to set them apart from the competition. These are key factors you need to consider. Number three is you look for growth catalysts. You look for catalysts that could promote growth in the company. So in this case, you identify product launches. So you consider new and innovative products that can drive the company's growth significantly. Not only that, you also look at the ability of the company to expand its market share, market expansion. Can it really expand into new geographies, geographic region or sectors? Or is it the type that cannot really, that the potential for, growth in market shares and geographical coverage? So you also need to look for strategic partnership. All right. Is it collaborating with established companies to kind of provide the resources it needs to grow? How credible is the company? All right. So number four is evaluate stock valuation. Evaluate stock valuation. In this case, you also need to x-ray the company's earning per share. The price to earning ratio. You consider the price to earning ratio. Is the PE ratio very high? Is it very expensive? All right. Is the stock overvalued, or is it selling at a reasonable valuation? And also consider market capitalization. You compare the company's market capitalization to its peers, to other companies in in the same industry to see whether the company is somewhat undervalued or not. Please like this video and subscribe to this channel if you've not done that. Number six is number six, or rather number five, you examine historical stock performance. In this case, you look at the volume pattern. How had the stock been performing historically? You look back and analyze its trading volume. Does it trade at a sufficiently high volume or not? That will indicate whether the company has liquidity or not. So that in case you want to buy or sell, you will not have problem trading your stocks. Number seven is number six rather is assess liquidity. In this case, you consider trading volume. All right. You may also look at volume patterns as well as price trends. Look at the company's graph actually and consider the price trends. So number seven is monitor, insider activity. Monitor insider activity. You look at insider buying or insider selling. Are those in the management team? Are they actively purchasing the stocks in larger quantity, or they are disposing the stocks, or they are selling off their position in larger quantity? So in that case, if they are selling, something might be wrong. But if they are actively buying, accumulating more shares, that means the company has prospects that are better known to the insiders, to the management team, than those even outside the company. Number eight is check regulatory compliance. So in this case, you consider transparent disclosure. When it comes to disclosure, you look for regular filings and accurate reports. How do they regularly present their reports to the SEC, the SEC? How regular do they present their reports? Okay, and avoid suspended stocks. Avoid stocks that are under suspension. Look for companies, that are not under suspension or that isn't undergoing any kind of investigation by regulatory authority or regulatory bodies. Number nine is use screening tools. To use stock screeners. So you leverage online tools to filter penny stocks based on criteria like market capitalization, revenue growth, and the industry it is located. Number 10, stay informed. Stay informed. In this case, you need to have to be updated regularly, as it relates to news that concerns the company. So keep track of company's announcement, industry development, and economic factors that could impact the stock in question. Not only that, you make sure that you key into investor forums. You make use of investor forums. So while not always reliable, forums can provide insights into market sentiments. By conducting comprehensive research and applying these strategies, investors can identify penny stocks with strong potential for growth and avoiding the ones that are not likely to grow as expected. And by so doing, you could minimize risk.